Did we just mark a key reversal in the S&P 500 today? That's what we're going to talk about on today's Stock Market Brief. Yes, I do sound different right now. I'm glad you noticed. Why? Well, because I am sick. I do not feel well. It hit me out of the blue, but yet now I'm coming to think about it. All my words have been jumbled up these last few videos, so apologize for that, but now it's kind of coming to fruition. I'm just not feeling good. So I'm going to keep today's video pretty quick and to the point. We're going to talk about the potential for a key reversal in the S&P 500 here. This little guy right here is a two-bar reversal pattern. It's known as a bearish engulfing. It's when price moves to the upside, and then we get some sort of a gap up, and then the bar reverses completely, closing at the low of the day, engulfing the prior day's candle. Well, in the S&P 500, we've been on a monster move to the upside, and we did get a gap up today. It went above the high of yesterday's candle. It went below the low of yesterday's candle, and the body of this daily candle engulfed the entire body of yesterday's candle. So this can mark a potential reversal. Now, I want to note that this was also on decelerating volume. This is a holiday week, so we have a shortened trading week. Then understand that we typically get less volume on these holiday weeks. For the most part, it doesn't always have to happen that way. Now, overall, when you look at the S&P 500 from a week-to-date performance, we're pretty much unchanged on the week, which tells me that we still have a wide open range as far as the weekly expected move goes. Going into tomorrow, we have a daily expected move of 411.35 and 405.99. The expected move today, the low was right around this level, and that actually created a lot of opportunities intraday because we are still above an inclining 5-day moving average. So as we moved outside of the daily expected move today, which was right in this area, it presented a lot of opportunities to potentially play back into the range multiple trading times throughout the day. If you wanted to look for bullish entries, that's something that you can do. Now, going into tomorrow, this is an opportunity here too as well. The 5-day moving average is still inclining, so if price were to open down this area, we may see some bounces from those levels. Note that we are still below the week-to-date, month-to-date, quarter-to-date anchored VWAP, so the bears are in control as it stands here, and we're kind of getting pinched between this shorter time frame, also bullish movement to the upside there in that 5-day moving average. Now, go ahead and take a screenshot of this if you want tomorrow's daily expected moves. I'm just going to go ahead and share this with you. These are the upper levels for these products. These are the lower levels for those products, and these are the expected ranges, the moves for those products as well. Now, we had JOLTS data come out today, which shook up the market, and I'll show you what asset classes, what markets do you want to watch when we get these macro drops, because they can have a big impact on the overall market. Yee. Holy moly. Tomorrow we do have some big reports coming out. Balance of trade, we have ISM non-manufacturing. So this is important to note on your calendar or on your trading screen while you're trading intraday, because if you're just trading intraday and you're unaware that a macro drop is going to come out 30 minutes into the open, you could get really quickly whiplashed around with the price action. So jobs data came out. What came out? Well, JOLTS job openings declined to 9.9 million in February. That was versus 10.4 million expected. Jim Bianco had pointed out that it dipped under 10 million open jobs in the United States for the first time since 2021, but he also noted that it is off the charts high when compared to any pre-pandemic level. So what assets really did make a big move? Well, if you were paying attention to the bond market here at 7 a.m. during that drop, bam, look at the 10-year yield. The bond market got completely just massive amounts of volatility. So why this fell off, you can take a look at TLT, which we did discuss on yesterday's episode. This thing fired off and it just held up there all day. Another asset to watch was the dollar. The dollar came down hard and fast on that data, sending gold up very strong. Brand new high there for 2023, once again breaking out of this consolidation here. Now, it does have a subtle divergence. We're moving into that overbought territory. So, just be careful trying to chase this type of move. We talked about that when we were running up here and we pulled back and then we came into this zone. So just be aware that, hey, yeah, we might get some more forward momentum, but if you are looking to add into positions, these are typically, if you're, full cycle trading here, this isn't where you really want to add to your position. This is where you might want to potentially take a little portion off and capture some gains or solidify some gains and trade around a core position. It's just really how you, perceive to play it. If I take a look at the 10-year and 3-month yield curve, this thing has reached deeper into inverted territory, making a new low for 2023. That is now 153 basis points inverted. What happened to the Fed watch tool as far as probabilities go is, well, we're sitting at around a 4.75 to 5% for the target rates, and you can see here this has actually dropped down. This was actually, the market was actually pricing in that we might be seeing a 25 basis point hike, and now it's shifted over on this data back down over here to being paused. So if I bring up the probabilities, it looks like the market's trying to say, hey, we're going to be paused here till July, and then when we come into September, we're going to start seeing the market cut rates or start to see the Fed drop rates. So that's something to pay attention to, because typically when the Fed starts doing that, we have seen turbulence in the market, which I don't have that long-term chart in front of me as of right now, but I'll bring it up another day. And then I want to just point out this too as well. As we're talking about, and we all hear that a recession is coming, I think it's pretty clear where we are in the economic cycle, in the business cycle, and we have earnings that are coming out here very soon for bank stocks. So this is going to be a very volatile, very interesting season. So we need to be very, very agile and tactical in the markets. You can see here KRE, this is the regional bank. This actually, excuse me. This actually almost had a new closing low since the banking crisis. So it reached down into this low territory here, not creating a new low, but you can see it was not too far off from closing from a brand new low there. If you take a look at XLF, this is the financial sector. It came into this 20-period declining moving average. And honestly, we had this bearish engulfing candle here too as well. So this potentially marks a turning point where we take a little bit back of a breather over here in XLF. And then the last one here too is I want to bring out Charles Schwab. Charles Schwab, it looks like it's just breaking down here, not looking too hot. This is a new closing low since the banking crisis. So a lot of movement on financials. We're moving into the earnings season here. Financials are the big dogs to watch because they're reporting first. Markets are clearly responding to macro data drops still, so we need to be aware of those on our trading screen. As it stands right now, short term still bullish, so be aware of the price action above that 5-day. If we start getting below it, it's going to start going to a neutral territory, and then we got to watch for it to potentially start to decline. And then we feel a little bit more comfortable from the short side. That's all I got for you on today's episode. Everybody have a wonderful day.